How's it going, everyone? My name is Amos, and as crazy as it might sound, I think Amazon is going to be the next Mag 7 stock to pop and rally. Check this out. So historically, they usually take turns underperforming and then overperforming. You remember Meta had their eventual rally in 2023, when in 2022, they were considered ugly and a bust. And then Google, for the longest time, they were always the most undervalued. Their trading multiple was like a 15, 17, and most recently like a 20. Now I think Google's trading for a fair valuation. And then of course Apple just got their rally. So I'm thinking it's gonna be Amazon's turn next. What you see on your screen right now is the Mag 7 and their performance for the past 5 years. Obviously Nvidia is in charge of the pack, 1,200% in the past 5 years. Microsoft 154%. Apple 126%. And then when we make our way down to line item number 5, Amazon 43% in 5 years. Dude, how the heck are they considered a magnificent company? If you click on their profile, check this out. Year to date, with Amazon, it's slightly above a 1% gain. For 10 months, are you freaking kidding me? And their current trading multiple is a 33.8. The S&P 500's average PE is around a 31x. So Amazon is just the hair above the average of all the other 500 companies in the S&P 500, which is kind of weird. Now, I'm not saying that Amazon's going to be the next Meta, where they experience this crazy rally of going from about $90 to what they are $700 in the span of like 2.5 to 3 years. By the way, I did buy Meta for about $87, $88 a share, and then I sold out of them once they hit like $200, $250. I did not expect Meta to go to $700. So I wish I would have held on, but what I'm trying to say is I think it's Amazon's time soon. Because when we take a look at Amazon's total return for the past 20 years, we're talking about a 10,000% return on investment. I think right now they're in kind of a pickle, but I think the show's not over. So in this video, I'm going to be investigating whether or not Amazon is truly undervalued. I'm also going to be calculating a fair price for them, like what's their inherent worth as a publicly traded company. And then towards the end of the video, I'll be going over my game plan. So if that sounds good with you, let's go ahead and get into it. I also wanted to give a quick shout out and say thank you to the individual that donated to the baby registry list on Amazon. You left your name as good luck, so I'm not really sure who you are, but dude, I appreciate it a lot. Thank you. But first things first, what exactly is Amazon and how do they make money? Well, I'm going to tell you this right now. Amazon's one of the biggest employers in the world, and they're basically a conglomerate at this point, kind of like a Procter & Gamble or like a Berkshire Hathaway. It's pretty tricky to evaluate Amazon because they operate in so many different segments and domains, but in the video, we're gonna try. And I say it's a challenge because for some of us, we might feel bullish on one of their endeavors, but feel disgusted by the others, and then vice versa, depending on who you talk to. Amazon's such a big company, I don't think you guys understand how many different sectors they truly operate in. Their bread and butter, I think most people recognize Amazon for their e-commerce marketplace where everybody basically sells their stuff. It's basically an online Walmart, and they've been offering their own private label brand for nearly every listing for the past like 3 to 4 years, and they're being pretty aggressive about it. I'm talking about Amazon Basics for clothes, food, and even deodorant. They also have AWS, which is their cloud enterprise. They also offer Amazon Prime, which is music streaming, video games, and even pharmacy benefits. Yes, friends and family, Amazon's in the business of delivering your drugs and medicine to your house. And they're also the parent company of Twitch live streaming. A fun fact, maybe like 7 or 8 years ago, I used to be a Twitch live streamer, but now I'm pretty much dedicated to YouTube. But anywho, Amazon's also the parent company of Audible audiobooks and Goodreads, which is a social media for book people, and IMDb, which is the official online resume for people in the entertainment industry. A fun fact, you can actually look me up on IMDb. I was actually a background actor in a music video, but it's not about me, it's about Amazon. Amazon also does advertising, which means they effectively monetize their platform so that the sellers can have their listing or item or whatever it is they're trying to sell prioritized. Like when you search hair clippers, the company that pays Amazon the most money will have their stuff front and center. It'll say sponsored. And they also sell electronic devices like Alexa, Echo, Ring, Fire, and the Kindle. And don't even get me started on their logistics, because not only did I work in the pharmaceutical space, but I also worked in logistics. And I have a pretty good understanding of Amazon's supply chain enterprise, and it's pretty massive and scary. They're about to turn into FedEx on steroids. They have the game plan set in stone, and the takeover is happening. They can pretty much do it all at this point. A to B in the supply chain equation. And what's crazy is they even have Amazon Flex drivers to do the last mile delivery, which, believe it or not, that's the most expensive portion of the equation of getting stuff delivered if you order something on e-commerce. But I think in regards to their logistics conquest, the key call out here is their development with robotics in the warehouses. I think the eventual game plan is to replace all of the various pickers and packers and line workers in the fulfillment centers with robots. But I think that timeline is still about 5 to 6 years away. I think the technology is getting up there, but it's not a one-for-one replacement just yet. And did you know that Amazon also operates grocery stores known as Whole Foods, Amazon Go, and they also have a ton of moonshot projects like Project Kuiper, which is their satellites endeavor for space. They also have Prime Air drones and Zoo X, which is their robo-taxi shuttles that's actually live right now in Las Vegas. From my understanding of the robo-taxi space, it's inferior in comparison to Waymo, which is owned and operated by Google. So as you can see, Amazon makes money from nearly every opportunity out here. And by the way, that's not everything. I think there's still like 50 to 51 other stuff that Amazon does, but on a high level, I think now we understand what Amazon is. They do a lot. And now let's go ahead and talk about the recent developments surrounding Amazon. Not too long ago, they just posted their earnings, and I think in the upcoming 3 weeks or so, they're going to be posting their next Q3 earnings. But in Q2, how did things go? They absolutely crushed the top and bottom line expectations, otherwise known as the revenue and the earnings per share, which is the bottom line per share. And they gave bullish guidance despite the tariff implications. They did talk a lot about the tariff situation, which is one of the reasons why they sold off after reporting their earnings, but Amazon's feeling pretty confident that for the rest of the year, the second half of the year, things will be pretty solid. And talking about some of their numbers and highlights, the AWS revenue is now $123 billion annually. Dude, that's pretty crazy. That's a lot of money generated from their cloud endeavors. And also, their advertising line of business, that revenue grew by 22% year over year. Friends and family, when we talk about the trade desk, I think Amazon is a real threat. They're coming after them. And their most recent Prime Day, they posted the biggest numbers in company history. So when people want to talk to me about how the consumer is pulling back and the economy is softening, it doesn't seem to be the case when it comes to Amazon Prime Day. People are shopping more than ever. And outside of their earnings, posted on October 1st, check out this headline. Introducing Amazon Grocery, a new private label food brand from Amazon offering quality products at everyday low prices, over 1,000 different SKUs. That's pretty crazy. I think prior to jumping into the deep end, Amazon was just offering stuff like bread, crackers, and snacks, but now they're offering the full array that you see in the grocery aisles. Case in point, check this out. You type in Amazon Fresh and you'll get the Amazon Grocery landing page. You can buy almost anything now. You can buy cheese, you can buy eggs, you can buy mushrooms, meat. Guys, they're coming after the grocery segment, which is pretty scary to think about because they also have Whole Foods, which is the organic, kind of bougie grocery store. I would put them in the same ballpark with like Sprouts and some of the other premium grocery chains. But now they're coming after the Albertsons, the Giants, the Ralphs, the Safeways. And between you and me, I actually really like this endeavor because groceries, it's a consumer staple. Doesn't matter if the economy is good or bad, we need to always be buying groceries in order to sustain life. So this is pretty scary to see. It's like Amazon's trying to become a one-stop shop for every single one of our needs. Medicine, entertainment, groceries, dude, the list goes on and on. It's kind of terrifying how powerful one company can be. And something else that's coming really soon is Amazon Auto. They're going to be launching their own version of Carvana. You can buy cars through Amazon and they'll ship it directly to your house. And I think, like I said, they're trying to become a one-stop shop for every single one of our needs. The next thing they're probably going to do is make a copycat version of Zillow to buy a house online. I think they're going to develop some kind of an online real estate marketplace. Watch, it's probably going to come to fruition in the next year or so. Because when we think about big purchase items, I think cars, it's getting up there. The next bracket up is definitely your living space. So they'll probably start selling condos, townhouses, single homes. Man, it's a terrifying spectacle to experience to see Amazon just putting their dirty little paws in every corner of the business world. Now, with all of that out of the way, let's go ahead and try to calculate an intrinsic valuation, like how much should Amazon's stock price be, predicated upon their own numbers and financials and fundamentals. The first analysis I want to run is the multiples valuation. Basically, we're going to be putting Amazon up against the other Mag 7, including Walmart, because I think now Walmart, they're not just a retail chain. They're copying Amazon in certain aspects. Walmart now even has their own subscription plan known as Walmart Plus, where if you buy into that, you get a whole boatload of different benefits. Like you can get a Paramount streaming service. You can get 5 cents per gallon of gas that you get in one of their network of gas stations. You get same-day shipping, etc. So I would argue Walmart and Amazon, they're almost one for one at this point. Whereas Amazon, I think, still dominates the online e-commerce marketplace. I think Walmart's quickly catching up, and that's why they're trading multiples at 38. So putting Amazon up against their peers, it's going to spit out a median PE ratio of a 38.9. As of right now, Amazon, they fluctuate between like a 31 and a 33. So besides Google, I would argue Amazon's PE is pretty low in comparison to their peers. So their stock price should be realistically $255. Depending on when you watch this video, Amazon somewhere around like a $220, $217 a share. So the upside to get to their inherent worth of $255, not the greatest, but objectively, they are undervalued according to the multiples valuation. And the next valuation model is going to be based on their PE ratio and their EPS, their earnings per share. But before we get to that point, something I want to call out is for the past 15 years, on average, Amazon's PE ratio was an 82.3. If we zoom in and only consider the past 10 years, then we're talking about 101. If we only talk about the past 5 years, 49.7. So no matter how you spin it, twist it, pull it, or slap it, Amazon's PE ratio being a 33, it's pretty low in comparison to their own timeline in history. When you compare Amazon to Amazon, it's trading for a very low valuation. I put my fingers like this because for a normal company, a 33, I would say is kind of high, but for Amazon, it's low. So with that in mind, if Amazon finishes out the year with a PE ratio of about a 35 and their earnings per share for the full year is $6.75, which is slightly below the average consensus and forecast for them, then Amazon, friends and family, $236. The upside from the current trading price of about $220, $221 to get to $236, not the highest, but we also only have about 2.5 months left in the year. However, if for whatever reason the narrative changes and it shifts and everyone's feeling super bullish and excited about Amazon again, and their PE ratio jumps up to a 50 while still pulling off a $6.75 EPS, then Amazon could hit 337. Do I see that happening? Honestly, sort of, but maybe not. Based on how things go at their next earnings, which is coming up here in the next like 2.5 to 3 weeks, if they crush and they say like, dude, the tariff situation, it was blown way out of proportion. It was nothing. I think I can definitely see Amazon popping up to like 240, 242, but bridging that gap to 337 seems really unlikely. However, if we play this game and we jump forward to 2028 and we're talking about an EPS, which is their profits per share of $11.18, and the market continues to feel, I guess, bearish towards Amazon, because their historical PE is around a 50, but they valued them at a 35, then Amazon could be $391 a share. Now, if we talk about the bear case scenario, I mean, right now their PE is a 33, right? So if that in fact happens, they might finish out the year of 2025 at $222 a share, which means as of right now, they're trading for a fair valuation. Now, is that the new norm? Is that the new future for Amazon? For their PE to be a 33 instead of a 50? I don't know. I genuinely don't know. However, one thing that I do know that we should all be aware of is that Amazon, their EPS, it's a lot lower than the other Mag 7 because they have a crap ton of CapEx and a lot of overhead costs and physical assets to produce, manufacture, and to maintain. When we think about Google, when we think about NVIDIA, when we think about Meta, pretty asset light. They don't really have that many overhead costs. Dude, when we think about Amazon, they have entire fleets of trucks, planes, warehouses, fulfillment centers, robots. There is a lot of things that's accounted for in the balance sheet. And over time, they write down those costs. So as a result, they depreciate a lot of their assets on their financial statements, which makes their numbers look weaker. It should be realistically higher, but depreciating your assets, it's the name of the game. It's accounting manipulation that you need to take advantage of. So their EPS being $6.75, which brings us to the compounder chart. Now, friends and family, what you see on your screen right now are all of the various companies that we covered on this channel in the past 4 to 5 months. If you search my YouTube channel's history, you can find any one of them if you want the full deep dive and analysis on whoever you're curious about. Now, like I said in the beginning, Amazon's a really tricky one to put a finger on, to say like, oh, they're undervalued, oh, they're a good stock, oh, they're a good operation. Because depending on who you ask, they might feel excited about their robo-taxis and others for their e-commerce retail. For me, I feel the most bullish about Amazon Pharmacy, their advertising line of business that's scaling at a very aggressive rate, and of course AWS, right? As a hyperscaler, if you don't feel bullish about their cloud endeavors, I feel like you're not really looking at Amazon the right way. And I also like their grocery operations and Amazon Prime TV. They are the parent company for the production that's making the Lord of the Rings TV show. I know it's very polarizing. Some people hate it. I actually like it. I think it's half decent. And when you think about it, Netflix, they only really have a streaming line of business. And because of that, they trade for a pretty premium. And that's why when I think about Amazon having a streaming service as well, it's like I ultimately like Amazon a little bit more. What do I feel bearish about? I'm not exactly in love with their e-commerce arm of the business. It's a loss leader for their business, but it makes sense. I think their game plan right now is to offer everything under the sun and the moon, and at a scale and at a convenience where people only shop with Amazon, which makes their competitors go belly up. And then eventually, I think Amazon's gonna hike all of the prices across all of their products and offerings because they want to increase their margins. But as of right now, it's kind of a bittersweet thing to see and witness. It's almost exactly what Walmart did to a lot of ma and pa shops. Amazon's gonna drive a lot of businesses to go away. And once they do go away and they're effectively a monopoly, that thing that you like to buy on Amazon that seems to be $1 cheaper than it is at the store, it's gonna go up by $3, $4. It's gonna be more expensive. I'm calling it right here. But anyways, when it comes to placing Amazon either into the left, a certified compounder category, or into the right, Kager graveyard, obviously if we only take into account and assess Amazon the past 5 years, realistically, they would be on the right side, Kager graveyard. To only have a total return of about 38 to 41% in 5 years, that's absolutely unacceptable. Because this is one of the biggest bull markets we have ever experienced. And some of the companies that you see on the left-hand side, they've experienced crazy numbers in the past 5 years, except General Mills and Clorox. I think they're suffering a little bit. They're a part of the consumer staple sell-off that's happening right now. But Google, United Health, Oshkosh, and MP Materials, yeah, compounders. And so I think that begs the question, you really got to ask yourself, like, why is Amazon only up less than 1% year to date? Especially when you take into account Google, Microsoft, Meta, their peers. Dude, they're up by like 20, 30, 40, 50%. And Tesla, depending on when you take a look at their stock price chart, could be like 1% or like 100%. They're so volatile. And I think it's because Amazon's dealing with issues left and right. It's kind of like when you think about World War II, there was the Pacific Theater, but also Eastern Europe, and I guess all of Europe, there was a battlefront, right? But you can't neglect North Africa. Basically, the entire world, you had to prioritize and be strategic of where you wanted to allocate your infantry battalions and everything. But anyways, for Amazon, I think they're dealing with a lot. I think number one, I think the big scary elephant in the room right there, Seahawks, go Seahawks, woo, is tariffs. Because they sell a lot of stuff that's imported from China, and the price increases across the board might make consumers to think twice whether or not they want that stupid little gadget for like 20, 30 bucks. Because now it's up to $40, $41, and they're like, oh, it went up by $10. I don't know if I want it. So that obstacle is there. But I think number two, we're going to be taking a deeper look at their numbers here in a little bit. I learned that when I go too deep into numbers and data right up front, I lose too many people. Their eyes start glazing over and they're like, dude, I don't even know what we're looking at. So we'll be looking at the numbers here in a little bit. But objectively, Amazon's growth across the board is slowing down. I think some lines of their business, it's still growing at a very hyper pace. But for the most part, I think the rocket ship is, instead of going straight to the sky like that, now it's more at an angle, especially with their cloud market share. They're losing a lot of their cloud monopoly that they had to Azure and Google and to the other players in that field. And it just kind of makes me think about some other things that I really don't like about Amazon. I think number one is how poorly they treat their workers. I think Amazon, they like to tout and publicly post all over their websites how they're the best place to work on earth, but their employees, they would beg to differ. Because the thing is, if you have the choice to join any other Mag 7, you would take that choice. More often than not, if you have a job offer from Apple, Microsoft, and Amazon, 9 out of 10 times, depending on who you are, you're going to go with Microsoft. Or Amazon is usually last choice. But most of the workers end up going there because of the compensation package, or it's their only choice. And I don't think it's any surprise, but if you work in Amazon corporate, middle management, or even if you're at the hourly level at one of their fulfillment centers, dude, it's a pretty tough place to work for. And to expand upon that point, number two, something else that I don't really like about Amazon, I think the reason why it's such a less than desirable place to be employed by is because of their management and leadership team, like the higher echelons. I would argue when we think about Andy Jassy, but also taking into consideration the other C-suite leaders in Amazon, they're probably the lowest on a subjective scale out of the entire Mag 7's leadership. I think best in class, probably gonna have to be Microsoft, Google. Their vision, their innovation, the way that they're guiding their boat, really admirable. But when we think about Amazon and their high leadership, they just lack substance, vision, coherent strategy, and bringing it all together. They're spreading themselves so thin. And when we think about Andy Jassy versus Jeff Bezos when he was steering the ship, Andy is just really unmotivating, uninspiring. And I think the work culture is usually a reflection of the leadership's expectations. When you're all about just the numbers and the bottom line, it becomes a place where you're not really looking forward to going on a Monday morning. Like, damn, dude, I gotta go to here. You know what I'm saying? And the reason why I can say this is because I have quite a few MBA friends that are working in Amazon right now at their headquarters in Seattle, in Nova, and they're absolutely miserable. But they're stuck there because their visas are sponsored by Amazon, but you can bet they're probably going to jump ship as soon as they're able. And based on my understanding and conversations with my friends that are working for Amazon, their work culture is just a pressure cooker. It's an environment myself I would never want to work in, but that's something I really don't like about them because they're probably losing talent all the time. And then that leads into retention issues and backfilling, and then the various teams and projects that are just operating with one less body. But that's not unique to just Amazon. I think every company is dealing with that, with people jumping ship all the time and moving companies every 1 to 2 years. Dude, it's a new time and age. If you think you got to be with the same company for 20, 30, 40 years, you're living in the past. I think most of us, we jump ship every year or two in order to get like a 10, 20, 30% compensation boost. It's just the name of the game. If you want to keep your employees, you got to give them a better raise than a 3% or 4%. You got to go higher. Don't just give them the end of the year bonus. You got to pay them for their work. But anyways, another thing I don't like about Amazon is that just like other major corporations, they're constantly in legal battles. Very recently, like a week or so ago, they had a settlement for $2.5 billion for their Prime subscription debacle and how difficult it was to cancel. Now, for the folks that are watching this video that work out, who've ever had a gym membership before, then you know it's like pulling a tooth or ripping your hair out to try to cancel your gym membership. And apparently Amazon was deploying the same tactics regarding the Prime subscription. And as of right now, I think the biggest dark cloud that's over Amazon and is pouring on them is their ongoing 2027 antitrust trial that's going to be happening with the FTC. And depending on who's leading the FTC, if we do in fact see another Lena Khan, they're going to go after Amazon to make an example out of them. And to be honest with you, I think Amazon's an easy target because Amazon employs about 1.5 million people here in just the US. If we think about globally, that number's a lot higher. And a good chunk of their US workforce is staffed inside their logistics hubs, their fulfillment centers, and warehouses making minimum wage. And that's why I think they're going to have a lot of battles coming up. And that's why the markets are a little fearful of what's going to happen with their pending regulatory antitrust probing. You never know what's going to happen. But on the flip side of that, it doesn't mean that things are going to be bad. Because if you remember Google, literally very recently, they also just had their antitrust probing outcome. And the court ruling wasn't as bad as we all expected. But up until that point, Google's stock price was suppressed because we didn't know what was going to happen. And then they shot up. And I think that's what's happening with Amazon right now. I think they're getting the same treatment because big money, when I say big money, I'm talking about Wall Street, hedge funds, super investors. The one thing they don't like the most is uncertainty. They would rather know, like, are you going to get slapped on the wrist or the outcome? They want to know. But if they do not know, that's when they pull their money out. And I think right now, Amazon trading for a 33, 32 PE ratio it's the lowest in their company history, which is a crazy thing to come out of my mouth. If you take into account the past 20 years, 10,000% ROI, that's the definition of a compounder. Obviously, the past 5 years, it's rough, but if I had to make an educated guess, especially with all of the different and various projects that Amazon is undertaking, I think their future is going to be bright. Now, you might disagree with me, but I'm going to go ahead and put Amazon on the left side. I still think out of the entire certified compounders category, I feel the most bullish about Google. I'm not a shareholder of Google. I sold out of them for a pretty profit. If things go in their favor in 2027, I think Amazon should definitely be right there, right next to Google. But their stock price is being suppressed right now, so I think they would be tier 2 in comparison to Google. And now let's go ahead and talk about my game plan. Now that Amazon's in the certified compounder category, am I going to buy into them? Well, I think it's a tough decision, right? First, let's look at their numbers. One thing that we do have to understand about Amazon is that they do not pay a dividend. And in fact, they issue more shares every single quarter and every single year because RSUs, it's a part of the compensation package for going to Amazon. But if we look at their numbers, I like what I see. I mean, the growth of their top line is just astronomical. In 2015, $107 billion. And in the trailing 12 months, $670 billion of gross sales. Objectively, that is beautiful. What is not beautiful is that the growth used to be like 30%, 37%, 21% as of recent, to be 10%. I know, sounds crazy, ridiculous. Only 10%. It's still magnificent. But in comparison to their own past, it's not so pretty. And when we think about their bottom line, it's growing at a pretty crazy rate as well, except fiscal year 2022. They probably had a lot of tax write-downs, which led to losses, but not cash losses. So negative 27 cents bottom line per share. But as of right now, $6.56. If we jump on over to their balance sheet, they have a crap ton of debt, by the way, because they have a lot of CapEx, but cash and cash equivalents on hand right now is $93 billion. Total debt situation, it's a lot. Are you ready? $159 billion of debt. Absolutely crazy, right? Take a look at their free cash flow situation, free cash flow per share. Yikes. And that's because right now they're spending a lot of money building out their robotics into the fulfillment centers. They're expanding their logistics hubs, but more importantly, they're building out their cloud network in order to support the infrastructure for AWS. Because if you don't have the bandwidth in order to support all of your customers, then you're really not going to generate money, right? So this is something they're doing right now in order to make more money later. So CapEx, it makes sense. And when we take a look at their metrics, breaking down their revenue by the various segments, and as I jump through their quarters, what I am looking at specifically is their AWS money increasing, but also the advertising increasing. It's pretty impressive. I mean, obviously the online store is $255 billion. I don't want to dismiss either. But I think when it comes to Amazon, I think there's one financial metric that really impresses me, and it's going to be the return on invested capital. The ROIC basically measures how much profit after tax a company earns for every dollar of capital that's invested into the business. In other words, how efficiently they're using capital when they issue new shares to dilute the shareholders, but also when they take on more loans. Like, are they efficient with their usage of capital? And when we talk about Amazon, right now, it's a 10.7%. Friends and family. 5% is the golden standard. Like, that's what a decent company can pull off. To see a 10.7% for a company that is really CapEx heavy, that is very, very impressive. Now, with that said, bouncing back to the original question, do I want to buy into Amazon? Now, here's the thing. I was right about Google. When Google dropped down to about $140 a share this year, I was buying as much as I could. And now look at Google, $245. I was also right about Microsoft. When people were like, oh, Microsoft sucks because at the end of 2023, up until this year, so like at the end of 2023, they were like, what, $376 a share? And up until April of this year, they were like $359 a share, which means they went down. People were saying Microsoft sucks. However, I beg to differ because if you take a look at their numbers, it was beautiful. So once again, I bought into Microsoft and I bought a lot. And then once they jumped up in valuation, I sold out of them. I was also right about Meta. I bought Meta at $88 a share back in 2022 because everyone was fearful about Mark Zuckerberg's, what was it called, like the metaverse? They were like, dude, what is he doing? So Meta went on a massive sell-off, and I went all in into Meta as well. Amazon is undervalued, and that's tough for me to say that when their trading multiple is at 33, but in comparison to their own company history and how the market evaluates them, 40, 50 is more normal. At 33 for Amazon, it's just... With that said, I think I'm probably going to open up a position in Amazon very soon. I'm going to be monitoring them day to day to see what's a good price to open up my position, but I think I'm in. I'm sold. I'm jumping in. But I do want to call this out. Just because a company's inherent worth, I guess for Amazon, it's around like what, 222, roughly 236 a share, it does not mean that Amazon's going to reach that price, right? Amazon could continue to fall further and lower and lower. Amazon could potentially drop to like 190 or even like 160 a share. Just because their inherent worth is 222 doesn't mean they're going to go up. And having said that, I think I can also absolutely understand someone who just doesn't want to go near them, because I think Amazon's become way too big for their own good. I mean, that's what led to the eventual downfall of the Roman Empire and the Mongols, when they were just trying to do too much at once and it crumbles, right? I think their trajectory and all the stuff that they're executing on is just, it looks and it feels really good because the numbers are there. Now, if they were negative cash flow, if they were unprofitable, my opinion would obviously be different. But I think when it comes to Amazon, I would even argue they're a better alternative to Berkshire Hathaway, which is also another conglomerate, parent company of like Brooks Running Shoes, Dairy Queens, Geico Car Insurance. I think once Amazon overcomes their pending speed bumps, like the tariff situation, the FTC antitrust probing and everything, I think they'll be okay. Now, I could be wrong because I'm a genuine idiot. So I want to hear from you guys. How do you feel about Amazon? Do you think this is a good opportunity? Do you think there's more room for them to fall? What am I missing? Why should I not invest into Amazon? Because I feel like right now, I like what I see. Maybe not at $220 a share, but yeah, help me out. If you are a fan of Amazon, what am I missing? What's something good that you like about Amazon? Now, with that said, I love you guys. Stay safe. Good luck in the stock market, and I'll talk to you next time. And by the way, the date has been settled. We're going to be welcoming my daughter into the world October 15th. That's when the C-section surgery day is going to be. So, just giving you a heads up, starting October 15, going forward after that point, the cadence and the upload tempo for this YouTube channel, things might slow down. It's not because I'm quitting, it's because I'm going to be doing dad duty. So pretty exciting times, and I'm just keeping you guys in the loop. So talk to you really soon. Peace.